The man who solved the market helped me make over 6 figures in trading. Well, who is he? Well, this is Jim Simons, and no one has made higher returns than him in trading. $100 invested in his fund would have grown to $400 million in 30 years. In this video, I'm going to show you exactly what he taught me in his own words that has helped me transform my approach and helped me make over 6 figures in trading using a systematic approach to trading. Now, to get into this, I'm just going to reduce my camera size here so it's just a bit easier for you to see everything. I'll be presenting it through his own words, meaning through his own quotes, and also read his biography a couple of times, which is an amazing book. It's actually named The Man Who Solved the Market. That's kind of where I took that from. And if you haven't read it before, I definitely recommend it. It's a great read. Now, these lessons that he has taught were actually so profound that I actually wrote them down in a small journal I have. The reason being is they are very simple messages, but they hold a lot of value in each individual one, and it's always good to kind of revisit these over the 5 years that I've been trading. Now, the first one, let me actually just zoom in a bit more so you can kind of see it clearly. The first one is past performance is the best predictor of success. It is really easy to fall into this trap of waking up, checking charts, and then trading just on gut feeling. I know I was for the first year at least. But Jim Simons focuses on what history and data can do to guide our trading. While I already know some of you will say, well, there isn't a perfect predictor of markets, and you're completely correct, but past performance is really the best thing we've got. It's used in all other industries. Think about any other industry where they're using historical data to test and validate their ideas. It's kind of the common practice in pretty much every other field, but for some reason in trading, a lot of people like to focus on, no, you have to use your intuition, your gut feelings, you have an idea of where the market's going to go just because of your experience. While it can be a factor of it, and if you've been trading for 10, 20 years, 100%, you probably do have some really solid intuition just because you've seen a lot of things. This will actually bring me into a point that it's a bit of a side tangent, but I think it's really important. It's a thing I like to think of. Let's just imagine you have a brain. So I'm going to draw a really poorly kind of like described brain here. Let's just say it looks more like a pie, but whatever. We're gonna roll with this. So for each arrow I'm drawing here, this is, let's say, 1 year of experience. Now, that 1 year of experience, you've probably watched the market for, X amount of hours. You've seen the market do X, certain patterns. You may be seeing it crash. You may be seeing it recover, all those sort of things, right? Because you've been sat at the screens and actually watching the market. And let's say you've been trading for 10 years. So there's 10 of these arrows. I'm not going to draw all of them now, but let's just say there's 10 of them, right? You have then basically put in a ton of sample data, so your kind of experiences from watching the market into your brain. And in functionality, your brain is like a machine, right? In some essence, meaning that it's got all that data, and then that's what's forming your intuition, which gives you maybe a better predictor of where the market's going to go because you've seen all these previous events. But in systematic trading, we're kind of shortcutting this because we're just actually getting the real price data, which comes with a lot of advantages. Human bias is a real thing, and even if you have 10 years, let's say 20 years of experience, you could be very biased on a certain predictor of the market just because of recency bias, of all these other biases. I'll actually do probably another video about all the different biases you can run into as like a human trader. But that's why personally, at least for me, I use systematic trading to shortcut this process. I'm not having to have 10, 20 years of experience to have seen all the different types of markets. And instead, we just use history and data, very similar to what Jim Simons does. And shortly put, this is what we take advantage of through backtesting and modeling our strategies over historical data to see how they performed and then make better decisions from that. It really has been the key to my trading growth. I think I'd probably still be a losing trader if I was trading discretionary, and this systematic approach has been the key thing for me. Now, the next part is the system is always leaking and we have to keep adding water to keep it ahead of the game. Now, while if I didn't have experience, building models, this sounds a bit loosey-goosey, doesn't really make full sense. But I think what he's trying to purvey here is that markets evolve and strategies decay. Now, you might be thinking, how do strategies actually decay? Well, fundamentally, most strategies or any edge or alpha over time will often become less effective because there are going to be more people entering doing that particular approach. Now, that isn't always true. I actually did a previous video of like 3 types of alpha, and that kind of went over that. There's one called like risk premium, which is more consistent and one of the more reliable edges because it's based on the difference between the risk-free rate and like taking on extra risk like trading stocks and holding stocks or equities, etc. But for the most part, most strategies do decay. If you actually have some alpha, it probably will decay at some point. What worked last month might not work today. A really easy example of this I just want to kind of share is in 2020, you could probably buy anything, almost anything, and it would go up. It was very, very easy to have any long strategy that was working, and I know a couple of traders that made 7-8 figures just by doing breakout strategies. If you're wondering what a breakout strategy is, let's say price was trading like this, and we have this kind of like high that is formed here. If it broke out above that, then they would take it long. There were different ways of doing it. Some people tried to get in on bounces and add it to positions, etc. But fundamentally, that's the core concept of a breakout strategy. And in 2020, you could print money just doing this. If you knew about these sort of fundamental principles before, it was an amazing market environment, and it was a lot easier. Let's say it wasn't fully easy. It wasn't like you put in $1 and instantly get $10 out. But the win rate and the follow through of those particular breakout strategies were incredibly high. But coming to today, very different market. Not many things are working like that anymore. There is obviously still some breakout strategies and winning trades, but it is not as easy of a market environment, meaning that overall that the strategy has decayed. This also hits home for me because I had one of my strategies stop working in 2024, and instead of forcing it, I had to adapt. And the way I adapted was building new models, but you can also improve your model. There's different ways of looking about it. If it's not a very specific alpha. So a really quick example of this, let's say it was an arbitrage between two different platforms. I think I've drawn this similar example in a different video, but let's just say we had two platforms. One is black, one is red, and they had different mispricings on a particular asset. If one was showing a lower price than the other one, you could buy here and sell there. You would make the difference. It's kind of like that strategy where people go on Craigslist and buy something cheap and then like fix it up a bit and then sell it higher. It's similar to that, but you're just not doing the whole middle section of fixing it up. And for this particular example, if this strategy no longer works, there's no way you're really going to be able to improve this or make that exchange have a mispricing again, unless you find a new exchange. That's kind of the only other way. So you do have different approaches of how you can add water to keep it ahead of the game, etc. And my personal way most often is at least building new models, so building new strategies. This is why constant research is also needed as a trader, and you're never done learning and adapting. As a trader, I'd say most of your time in your career, you're going to be learning constantly new things. I know I have been, and even people 10 years ahead of me always say that they're learning new things as well. It may not be as at a fast of a rate because obviously they've just been longer in the game, so there's not as much to learn, but they are always learning at least something new. Now next is, he says, we have 3 criteria. If it's publicly traded, liquid, and amendable to modeling, we trade it. And the core lesson I took from this was you don't want to limit your options for finding alpha. You want to scope out new areas, new markets, and often the newest markets actually have the most edge to be exploited. This is because they're normally the most inefficient. So think of crypto back in the day, and I've even heard like the Indian market has been decently inefficient, but I personally haven't traded it. Personally, this is just from what I've heard, so that may be a bit different, but I definitely know back in the days, 2015, 2017, crypto, there was tons of inefficiencies, and even really up until like 2019, and still nowadays there are a decent amount. Now the next lesson, very simple lesson, but incredibly true, is we don't override the models. And it's one of the hardest parts of systematic trading, in my opinion. When your system is going against your natural intuition, whether you've built that open up the first year or over the past couple of years, when it goes against your natural intuition of the market, every fiber of your body can be screaming, hey, this is a bad trade, you shouldn't be in this trade, etc. But this is where you really need to trust your strategy and just keep going. If you have backtested it properly and you have a good amount of data that supports this particular strategy, you have to give it the space and time to execute. This alone has made me the most money, as my market intuition is bloody terrible, if I'm being completely frank, but my strategies aren't, because I've spent a lot of time backtesting them, and they are based on really core principles. Another actually quote, I can't remember who this is from, but it just came straight to my brain, was you never want to base it on recent price action because you don't have recent data. You don't have enough of that recent data, if that makes sense. So let's say you've had 2 or 5 bad trades this week with your particular strategy. That is not enough data to completely reconstruct your strategy or get anything statistically significant about that to change. Now, the only caveat there is if it's an incredibly outsized loss. If it was something that you hadn't predicted or seen in your models, then that is something that, yes, you could learn from straight away, and you don't need, tons of examples for that. But if it's just normal losses, as it should be with any strategy, you're going to have drawdowns, and this is just a part of it. So you really do have to, don't override your models and just keep to it. The next is the best decisions are often made with data, evidence, and not just gut feeling. Back in the earlier days when I was trading, I traded with any catalyst, I followed random alerts from people, and I was overall just following my gut. If my gut was saying, hey, this price chart looks sort of bullish, I'm taking it along. That's basically how it was. But after actually being more systematic, I backtested everything, so every strategy was fully modeled out. I required statistical proof before I took any action, and I ignored opinions without data. And this is really when my account started to grow consistently. Now, I'm never going to be, closed-minded enough to say that discretionary trading doesn't work. I have no really good discretionary traders, and I would never say that it's something that can't work. At least just in my opinion, I don't think everyone is the same, and we all have different strengths and cons. And at least for me, my fundamental reading of the market is very poor. I've never been incredibly consistent with it, but I am good at testing strategies and then letting them just play out and then kind of continuing that research. That's at least what I find enjoyable, and it's been the most long-term, consistent process for me. Now, the next one is persistence and discipline are key traits for long-term success in any field. I know this is really simple, but it's one of those core lessons that just still remains true. And as the rule of thumb says, it will normally take you double the time you actually expect. And this is very true for trading. But the outcome may be even bigger than you anticipated. Sometimes you just have to keep at it for enough time. I remember in the first year of trading, I know it sounds delusional, but I really thought I was going to, make 6 or 7 figures like, everyone on YouTube kind of shows. But that was just not the truth. It took me double the time. And I'm still not even at 7 figures, but I've been very blessed to cross 6 figures. And, hopefully over time, I'll get to 7 figures as well, as you kind of have that exponential growth curve, especially if you're adding more size. But while this is maybe a bit of a simple lesson, where you are having times where you're thinking, oh, how much longer is this going to take? Or you're thinking of doing something you shouldn't, maybe modifying your strategy after, only a losing trade, you kind of have to go back to this quote and really think that this is the man who has, had the highest returns really compared to anyone. And, this is one of his core lessons still. It's a bit cliche, but it's very true. The next one I really like, because I don't think many people really think about this, and I think many people are trying to look for the perfect thing. And his quote is, everything is to some extent a compromise. Not everything can be perfect. And this is really the secret nobody tells you. Perfect strategies don't exist, perfect entries don't exist, perfect exits don't exist. End of day, everything has its pros and cons, and you need to take the ones you can deal with. For example, I may miss many discretionary opportunities because I'm systematically trading. And this is normally due because they are more rare events with limited data. That's normally something quite consistent with discretionary opportunities that are very outsized. They are very limited data, and it's relying a bit more on intuition rather than actual historical proof. However, the pro I have is now I can have way more conviction in my strategies, which leads to better performance in the long run than if I had adopted discretionary trading as I was in my first and kind of second year as well. And this applies to everything. I could probably ramble about this for another 10 minutes, but no strategy is going to be perfect. I see a lot of people try and aim to create a strategy that works in all market regimes, works on all instruments as well, and all those sort of things. That's just not going to work. It might work historically because you overfit it. If you're not too sure what overfitting is, it's pretty much just where you add too many parameters or you over-optimize particular values to make it look amazing on historical data, because ultimately historical data isn't infinite. So if you go through enough iterations, you will find something that works, and that causes overfitting where it's not actually going to work on live market. There's multiple different techniques and ways we can avoid that, but a lot of people try and find the perfect strategy by doing this because they ultimately want something that they can just, have ultimate faith in and think it's going to be perfect and never going to lose them a single trade. But that's just it's not reality. It won't work on live markets. And the same for these two as well. You can never get the perfect entry on every system, and you can never get the perfect exit. Maybe we'll have one or two that, are kind of perfect on that particular day or chart. But over the long run, you have to accept what cons are you happy with. And then that's going to give you a lot more of a reliable and also content approach to the market, at least in my opinion. Now, this is already becoming quite a bit of a long video, and I can't fit everything I've learned into a single YouTube video. So if you want to learn even more about systematic trading, check out the 2 links in the description. I have a couple free resources there as well, so hopefully they can help explore even further. Otherwise, I do upload videos every week, and you can also follow me on Twitter at GhostOrcTrades, where I tweet a lot about systematic trading and just trading in general. All right, yeah, I think that's about it.